have done research on. And that is basically China was the success story of the global economy for many, many years. And the growth rate was very high, a lot of urbanization, all that was a positive story. And then in the last few years, what we've seen after a period of overinvestment and high leverage is now stagnation. And in fact, even more pernicious, deflation that's emerging from the Chinese economy. So I want you, if you would, to start in and just tell us what the arc is in China. Where are we? Where are we likely to go? Is this going to be a worry for investors looking into the future?
Maybe let's take a step back and look at the perspective from history. China enjoyed a very exceptional period of growth rate, on average about 10.4% between year 2000 and 2010. In part thanks to this really fast and strong exports market share gain, especially post WTO entry in 2001, but also because of very favorable demographic profile as well as fast urbanization. But then the decade after that, maybe just before COVID, you see that growth has also moderated, but it's still very impressive at 7.3% on average between 2011 and 2019. And thanks to the three traditional growth engines, so this would be exports, investments, and consumption, but also, like you said, rising leverage. So this rapid rise in leverage really increases the vulnerability for Chinese economy. So when it comes to COVID, when COVID hit in 2020, we see quite a remarkable adjustment to Chinese growth rate to now 4.7% between 2020 and 2023. Now, there are obviously a range of confluence of factors at play here, some cyclical, some structural, but both sets of drivers are really acting in the same direction at the same time on the Chinese economy. So let's start with the cyclical factors. One is this post-COVID recovery has been quite subdued, so that has knock-on impact on confidence, business confidence, but also on job availability as well as wage growth. So year to date, till July, we have seen that personal income tax has declined by 5.5%, and that is after a minus 1% year-on-year in 2023. And based on the latest statistics that we saw, average wage growth in 38 major cities in China has decelerated from 2.2% in Q1 this year to now 0.5% in Q2. And this very soft, aggregate demand has also led to increase in competition, especially in some industries. So we have seen, for example, companies having to bear very thin profit margin in order to squeeze out other players. There's a term for it in Chinese, actually, it's called 内卷, which I think the English translation is involution. So, for instance, the number of loss-making manufacturing companies has surged to something like 180,000 as of May of this year. And this is about 30% of total firms in China. And this number is double of what we saw in 2021. And there are some other cyclical factors as well, such as lower prices in pork, in commodities, and so on, that's acting as a deflationary pressure on a cyclical basis for the Chinese economy. But perhaps more importantly are the structural drivers. And these would include things like demographics. So we have passed the peak of favorable demographics in China. And there's also a profound shift in the Chinese economy model, as well as the accompanying priorities change in terms of policymakers trying to target now quality growth instead of quantity growth, as well as a policy-led structural adjustment and deleveraging in the system, especially in the real estate market. So take real estate, for example. The impact from deleveraging in the real estate in the economy is very significant. Real estate used to be something like 26% in terms of GDP share in 2020. Today, it's 17% as of 2023. And the property market also has very large knock-on impacts in terms of the credit chain. So, for example, in local government financing, in consumption of and demand for commodities, as well as accounts for something like 60% of households' wealth in China. And this structural adjustment is going to take some time because it's very difficult to find something like a real estate contribution that can replace, in terms of growth engine for the Chinese economy in a short period of time. And this structural deleveraging in real estate also coincided with a peak of population, decline in number of marriages in the system in the country, and it also has coincided with a low level of urbanization rate as compared to the past, as well as elevated property prices, income and high household ownership as well. So all these would take time for us to be able to find a new growth model. And lastly, I think in terms of external pressure, we have rising geopolitical tension and talks on trade frictions and so on. That will continue to exert pressure on the Chinese government to look for other ways to which they could think about national security and also the system self-sufficiency, so that in the next phase of growth, they will have to focus on some of these other things.
I think that paints the picture extremely well, right? When you look at this in our framework, right, you've got a long-term debt cycle problem in the private sector and fixed income in China. And deleveraging is a part of these choices they make. And right now, China's decision is more to cut that. Right? If you take COVID, every other economy in the world built a gap. There's a massive gap between basically close down the economy. Longest also. Close down the economy, fixed costs keep running, and revenue drop. There's a big gap. Right? When we went into COVID, I was calculating that gap across countries and said, like, it was a huge problem. I didn't know the fiscal response in the developed world would be large enough to more than fill that gap. That's an interesting learning. But in China, they did it. And so on top of these problems we're building going into COVID, you had the problem of the massive leverage going into it. Now you take COVID, you get this incredible gap between the revenues go like essentially to zero and the costs keep building. And the way they chose to handle it in China was tell the banks you have to lend them. But unlike the rest of the world, those debts were not forgiven. Those debts have just built up on those balance sheets. Banks are the mechanism through which kind of bad debt is managed. The defaults don't really happen. So you're stuck in this limbo. Defaults happening at a very slow rate, basically not hardly. Banks forced to continue to kind of lend to companies that are losing money, and that circumstance keeps the ball rolling, but the problems don't get dealt with. Now, at the same time, there's some fundamental really strong things in the Chinese economy. The central government can handle a lot more debt than it has, and they're choosing not to do that. So, kind of two thoughts on that. I think when you look at the underlying strengths of technology, and the fact that the central bank right now is not, the central government is choosing they're choosing. Those are powerful levers that still remain in play. And finally, pricing. We talked about the U.S. China's the opposite. Market pricing is extremely depressed in terms of what's being expected. Now, good reason for that because of the political challenges and whatever, but it is, by our measures anyway, an extremely high risk premium, a well-earned one at this point, but an extremely high risk premium that is pricing in negative earnings growth in the future compared to something like the U.S. where there's pricing exceptional earnings growth. So those are interesting differences.
I want to add that there are different considerations for the government. So what are some of these? Number one, we must have regime and social stability. Number two, financial market stability. Number three, national security. And then fourth, economic growth. So I think above all, it's going to be a very tough balancing act because you have got so many different considerations and they're all acting at the same time in terms of some of these pressures. The broader picture is that we're coming to a very significant transformation of growth and economic model in China. And it requires a different lens to look at the state of the economy as well as how we invest in the market.
I want to turn to Jeffrey with a question. In the joint work that we did, one of the interesting things there is that there's 21 case studies of deleveragings that are studied. And what you see there is that the distribution around the outcomes is very stark, right? If you're early and active and you're essentially monetizing away the debt, you may have some repercussions from currency, but you're going to have a better economic outcome. And if you wait too long the other way, then the concept, the reality of deflation expectations starts to set in, highly damaging and very difficult to get out of without really radical policy. So, sitting here, we see what's happening. As an investor, we've said, well, a balanced portfolio of bonds and stocks and other things is the best way to play that, and it's actually done quite well, even as this deleveraging has occurred. But as an investor in China, how do you see playing this situation, given that they're sort of going down this one track?
I think the problem, if you will, for policymakers as well as for investors is pretty much the same one, which is trying to understand whether this is a stable equilibrium that the lower growth and all these leveraging that's occurred, can they still kind of hold it up here, or in a semi-market economy or a full market economy where you don't control everything, you definitely don't control the sentiment and therefore the economic consumption decisions that consumers make. Is it an unstable? Which means that once you don't arrest it early, as actually you are already in this kind of vicious cycle that leads to a much worse outcome. I think, if you look at history and so on, clearly it shows that risk is actually relative, very fragile. Lots of examples of this not being controlled. And I think the Chinese policymakers historically have looked at Japan and said, we don't want to be Japan. And they're very worried about that. But this time, their policy response and so on seems very constrained, as you need to describe it. And I think as investors, as opposed to policymakers, if we think that this is an unstable equilibrium that could lead to a vicious cycle, and I think that unfortunately is a very tough one. It doesn't mean that there isn't a range of things that an investor can do. You can build a very nice balance. I think for long-only asset owners, it's a very different problem. I think it's one where I can own Chinese bond at the start with a low bond yield and get some capital gain. Keep investing with that, just get that to the bond. Is that what you want? On an equities perspective, I think there is a difference between investing in an aggregate index that gives you the whole economy and all the problems that comes with managing the economy and deleveraging, versus looking for companies that can still perform well absolutely in an environment. And so there are opportunities, whether private equity going in and taking control of a company, or looking for the companies where they've really decided to govern themselves well, where you can really translate what is still decent revenue growth, maybe they're even gaining market share,